Okay, without further ado, let's start the webinar. For this session, we have J.Y. Tan, Head of Research from PhillipCapital Malaysia, to cover what has been driving the strong market momentum in Malaysia, market opportunities for 4Q 2024, as well as sectors and stocks to focus. Let us welcome him.
Okay, thanks for the introduction. Good afternoon, everyone. Good to see all of you here this afternoon, and good to be back on sharing on our fourth quarter 2024 outlook strategy. As usual, what we will be running through today is on the global Malaysia macro before moving on to the Malaysia market strategy, which we'll be touching on in terms of our CI target, what thematics that we are looking at for the fourth quarter, what are the sectors that investors should be looking at, as well as some of our stock picks that we will be highlighting for the fourth quarter. I guess that as we, of course, enter into the fourth quarter, we do believe that there's more reasons to be positive on the market. I think firstly, if you look in terms of the OPR, I think OPR has been relatively stable. If you look in terms of the GDP for Malaysia, I think that it's been on the good side as well. Political landscape has been stable, and I think most importantly is FDI is at the record level, moving into Malaysia. And of course, there has been a headline on foreign brokers reversing their bearish view on Malaysia from underweight to a neutral call. So we do believe that that should actually result into a better sentiment as well. If you look in terms of tourism, I think tourism volume has been recovering quite steadily this year. So all in, we do think that there is still room for the market to actually trend higher. Okay, as you can see here, I think the economic outlook across Asia particularly is still looking optimistic. The two powerhouse, China and US, I think is expected to support the global environment. I mean, of course, admittedly, the global manufacturing PMI numbers over the past 2 months has been a bit weaker. So of course that would result in that will affect country like ours, which is an export-oriented country. But that being said, if you look in terms of the service PMI, I think that is recovering fairly nicely. So I think once the global manufacturing PMI recover, we believe that these two twin engine will continue to signal a better outlook, and of course Malaysian to actually stand to benefit from it. Over here, as you can see, a positive GDP projection forecast for both China and US, for both the powerhouse. Over here, you can see that Fed has been aggressively raising interest rate in order to contain the inflation. And most recently, I think that the highlight for last month was the fact that US Fed has decided to cut the Fed funds rate by about 50 basis points. So I think that's a positive sign. So that has caused a rally in terms of the US market in particular. I think that if you look at the dot plot analysis on the next slide here, you can see that market is effectively looking at about another 50 basis point cut for the remaining part of the year, and another 100 basis point for next year. Of course, if you guys are traveling to oversea or been to a mall, you guys will probably notice that the money exchanger is getting longer and longer in terms of the queue. As you can see on the graph on the right here, the aggressive interest rate hike over the past few years has resulted in a very strong US dollar. But most recently, with the expectation of further cuts ahead, as well as the 50 basis point cuts that's already been done. So that has resulted in a very sharp depreciation in terms of the US dollar against the ringgit. And I think that not just against the US dollar, I think that Malaysian ringgit against the rest of the regional currency, I think that we have performed relatively well as well. Yeah, so like I was highlighting here, I think in third quarter, when we had this session, Malaysian ringgit was down by about 3%. But this time around, it's up by about 6%. So effectively, ringgit has appreciated by about 10%. So we do believe that the stronger ringgit will result in a very stronger equity market, which I will bring to you guys in terms of the data point. So I think one of the most common question that we have gotten is considering that ringgit has done relatively well over the past couple of months. What are the expectations moving forward? I think that we do see room for ringgit to continue to strengthen. I think if you look in terms of the Malaysian GDP growth data, last year, part of the reason why ringgit depreciated so sharply was the fact that fourth quarter GDP numbers actually missed expectation. But if you look in terms of this year, next year, GDP numbers is looking positive, and we do believe that this will drive the stronger ringgit. In terms of the global semicon market, I think that the semicon market is expected to recover, again driven by the US and Asia Pacific. Over here, you can see why does it matter is the global E&E sales recovery is actually a bellwether of the Malaysian E&E export improvement. As you can see here, there's usually a year lag period between the global semicon sales and Malaysian E&E export recovery. Usually that takes about a year or so. So we do believe that it's imminent that Malaysian E&E export will actually recover next year. The next slide here actually shows the government economic reforms, the likes of your NETR, your NIMP 2030, 12 MP. I think all these are one of the few positive initiatives. And of course, as you can see, this slide here, government higher DE spending for investment is expected to stimulate the economy by reviving some of the key construction projects. As I mentioned earlier, Malaysia continued to benefit greatly from the FDI inflows. The recent heightened geopolitical tension between the US and China has resulted in increased number of MNC actually adopting, the China-Taiwan plus one strategy and diversifying the supply chain out of China into the EMs as well as Malaysia. So obviously, ASEAN countries, including Malaysia, will continue to see and benefit in terms of the FDI. On the right here, we have seen about 4 or 5 quarters of recovery in terms of the foreign visitation volume. So we do believe that we are seeing a recovery in terms of the tourism sector, and it's showing a positive sign. The air passenger traffic volume is improving and actually on track. So all this, as mentioned, is expected to drive a stronger ringgit. I think that one of the things that investors should actually take a look at is also the US 10-year Treasury yield, as this actually helps to predict the ringgit movement. Okay, so from here on, this is we'll be touching in terms of the market. Just a bit of a recap. I think that KLCI has done fairly well year to date, up until September. Partly, if you look in terms of August as well as September, Malaysia has benefited very strongly in terms of the foreign capital inflow. And of course, a lot of this money has flown into the banks, particularly. And we believe that this shouldn't be taken as a surprise. Like mentioned, the macro data is pointing towards a recovery. You look in terms of the tourism, the record FDI, our sound fundamental GDP recovery, political landscape, as I mentioned earlier. So that has actually resulted in KLCI up close to about 15% year to date, excluding the dividends as well as a currency adjusted return, which will be closing towards the 20% level. Of course, following the yen carry saga, so that has hit the small cap fairly badly. So the small cap has underperformed the large cap year to date. I think in terms of the global markets, your US, your India, your Taiwan, your Japan, which I'll be explaining later on, I think these are the market that has done well. If you look in terms of China, Hong Kong, I think China, Hong Kong has suffered broadly most of the year. But if you look in recent weeks, with the China stimulus, I think that both the market is actually back into the spotlight, which again I will explain in further details later. Okay, here just again zooming into the sector as well as the stock performance. Construction, utility, the financials, the property is some of the sectors that has done well year to date. If you look in terms of the FBM KLCI component on the right side, I think most of the big cap is doing fairly well compared to last year, where it was just broadly being propped up by both the YTLs. Okay, here is where I would like to spend a bit more time here. This table here shows the foreign equity flow of the Asia 6 market as well as Malaysia. As you can see here, the blue column, you can see that Malaysia has been doing fairly well this year. As I mentioned, especially over in the month of August and September, where we attracted close to about 4 billion ringgit of inflow. So that has been driven by the reasons which I mentioned earlier on. If you look at the Asia 6 market, represented by your Indonesia, India, Korea, Taiwan, Thailand, Philippines, I think year to date, they have attracted about $6 billion US dollar. But most of the money has been flowing into the likes of your Korea as well as India. I think part of the reason is of course due to the AI factor. And that is also the reason why your US market has broadly done well. I think apart from the foreign equity fund flow, I think if you look in terms of the retail participation of the market this year, I think retail participation has been declining. It has been averaging about close to about 30% level, 25-30% level. But if you look at year to date, I think that we are close to about half of it. I think that this is due to a few factors here. Of course, year to date we have seen a lot of IPOs with very high subscription rate. So I do believe that that has taken out a bit of the liquidity out of the retail investors. But we do believe that with the sound economic environment for Malaysia, we do believe that there's actually more reasons, more compelling reasons for both the retail participation to actually increase, as well as continuing to attract the foreigners into Malaysia. So as I was mentioning earlier on, basically the reason why we are positive in terms of the ringgit is there tend to be a positive correlation between the stronger ringgit as well as the equity market. Stronger ringgit is expected to sustain the market momentum ahead, and we do believe that likely that in the fourth quarter, market barring any unforeseen circumstances, market should actually do better. Same thing here. We do believe that with the sound GDP growth for Malaysia, equity market should actually do well as well. Better GDP growth tend to have a positive correlation with better corporate earnings, and ultimately should actually benefit the equity market. Okay, so basically this just shows you in terms of the US equity market valuation. As you can see here, the US market is by no means cheap. S&P on the left, as well as Nasdaq, is actually trading close towards the +1 standard deviation. But I think that we have been right so far. I think end of last year, early part of this year, we have been highlighting to the investors that 12 months leading up to the US election, market tends to do well. And this year, we continue to see this trend being staying that way. Hence, it's only waiting to see, what's the outcome of the January election. Okay, we have always been advocating to investors that we do believe that money continue to lies with the small mid cap. As you can see here, this year being a very exceptional year. But if you look in terms of the past 10 years or so, most of the year, FBM, TLCI, which is represented by the large cap, tend to see a negative return. Whereas if you look in terms of the FBM small cap tend to outperform the market. I think that the reason is obvious here. I think if you look in terms of the earnings profile, small cap earnings profile tends to be a lot more stronger compared to the large cap. And small cap tends to have a more interesting business model, whereas your large cap tend to be represented, by your plantations, your telco, as well as your banks, which is a bit of a sunset industry. But like we were mentioning here, if you look in terms of the market valuation for Malaysia, both in terms of the PE as well as PB, I think that it is still trading at a cheap valuation, a fair valuation, I would say. And we do believe that there's actually room for the market to actually trend higher. Okay, we are overweight on 9 sectors, and that's where we would like to position the market in fourth quarter. We are overweight in construction, your EMS, which is your electronic manufacturing services. But we like the industrial names versus the consumer. We do like the healthcare. We do like the industrial, which is largely dominated by the data centers. We are also overweight in oil and gas, your renewable energy, your rubber glove, your technology, as well as your gaming. And the only sector that we are neutral on is actually on property. So with these 9 sectors being overweight, these are some of the thematic ideas that represent our overweight sector. As you can see here, I have been emphasizing again and again in terms of the influx of FDIs, as well as the trade diversion opportunity. I think that Malaysia has experienced a significant increase in terms of the FDI, particularly in the E&E, concentrated in Penang. I think that in recent quarter and year, we do see more of the FDIs getting more and more active in Johor, as well as Klang Valley, largely into the data center segment. So we do believe that moving forward, Penang and Johor will continue to be the 2 largest states to actually benefit from the FDIs. Of course, if you look in terms of this year, I think that Singapore has played their part in terms of contributing in terms of the FDI, and with the imminent Johor Singapore special economic zone, we do believe that there's actually more opportunity for the southern part of Malaysia. I think that the beneficiary of the FDIs, of course, is quite obvious here. The tech companies, some of your industrial park and property developers, which have exposure in both Penang and Johor, as well as some of the industrial EMS company, and of course, let's not forget the supporting contractors that has exposure in the data center segment. Thematic number 2, it's quite related to what I mentioned earlier on. Basically, Malaysia way of economic pump priming is always through the infrastructure spending. So we do believe that there will be more infrastructure projects to be rolled out in the coming quarters, concentrating on some of the few high-profile construction projects, and we do expect more news flow to actually be a near-term catalyst for the construction sector. Over here, you also constantly hear me talking about data centers. I think that Malaysia, no doubt, has really benefited very strongly from data centers, especially in the southern part of Malaysia. Reason being, of course, is close proximity to Singapore. Of course, the ample availability of the land, electricity, so on and so forth. And whenever you open your newspaper or going to all these news portal, you continue to see that US MNC is pouring billions of dollars into Malaysia, and we do believe that on the main con level, the contractors, or the sub-con level, which is the MEPs providers, they are all going to benefit from this in the coming years. So we do think that this is a very strong structural theme that investors should actually look at and position for 4th quarter as well as next year. Over here, talking a bit on the oil and gas. Oil and gas remain one of the sectors that we like. We think that Petronas CapEx activities should continue to spur the excitement into the sector. If you look in terms of the next year outlook as well as the next 5 years outlook, I do believe that Petronas will continue to spend the money this is actually due to the fact that during COVID, a lot of these platforms, a lot of these offshore assets have been under-maintained. Hence, it is something like your car, whereby once you have already hit the KM, your mileage is actually bound for servicing. So it's the same thing for the oil and gas sector. We do believe that Petronas will be putting a lot of emphasis within this space. Thematic number 5, we do believe that tech revival is imminent. of course, like I mentioned earlier, global E&E sales is recovering, so it's only a matter of time before Malaysian E&E export will continue to ride on the next momentum. And we do believe that it's just around the corner before the sector see a recovery. If you look in terms of the tech sector PE, I think that is trading at a much cheaper valuation right now compared to the past. So that has given that should actually give investors a better entry point for those that's looking for exposure in terms of the sector. I think that with your US Feds actually cutting your interest rates, growth names should actually be back into the focus as well. Thematic number 6, like I mentioned, we do believe that your foreign visitation will drive a stronger medical as well hospitality growth. So this should actually benefit the likes of your Genting Malaysia, your Genting, your hilltop visitation should actually be reflecting the recovery in terms of the foreign visitation volume. We are also positive in terms of the medical tourism sector as well. Here it's highlighting in terms of your glove. Of course, in over the past few weeks or so, we did see a positive development whereby US is actually imposing a full-blown higher tariff on your China glove makers, and as a result, that the market actually reacted very positively on the Malaysian glove makers. We do think that this is a very good development. This should actually progressively means that your Malaysia glove makers should slowly regain the global market share. And with this, some of the glove makers are effectively increasing the capacity in order to cater for the higher anticipated demand. So we do believe that in terms of the outlook, particularly for the Malaysia glove makers, we do expect them to actually benefit from it. Basically, this just shows all of you how has our stock pick done year to date, which has done fairly well. We call a buy on HE Gamuda, Dayang, Usma, just to name a few here. Okay, here basically this just shows you more of our coverage. The glove the tech is expected to see a stronger earnings growth moving into 2025 for you guys that will be keen. Here, apologies for that, there's a typo here. But with November closing in, we do believe that the Genting Malaysia has the risk of being excluded from your FBM KLCI in the semi-annual November review, falling to the 36th spot. And that is likely to be replaced by Gamuda, which has risen above the 25 spot. Okay. So some stocks to we have touched on the thematic ideas, and some of the stocks that to watch out for. Okay, so for the fourth quarter, Binastra is something that we would like to highlight here. We have a buy call target price of 215. So basically, the compelling story of Binastra is, of course, their profit margin is relatively more superior compared to industry average. And what actually differentiate Binastra from the rest of the contractors is the fact that they they have a very strong relationship with three prominent clients. Basically, your Exim, your Maxim, as well as a Platinum Victory. But I think that more importantly is on Exim. Exim has the largest land bank in Malaysia, close to about 30 to 50 billion. So we do expect that the robust pipeline will continue to support binational growth in the years ahead. And apart from that, they are also trading at a very undemanding valuation compared to the rest of the rest of the construction players, and that is the reason why we like them. We also like NationGate. NationGate is an industrial EMS player that is based in Penang. They have exposure into the 5G, your AI, your hyperscalers, as well as your GPU. I think that the key things to actually highlight to the audience this afternoon is they have started delivering their AI as well as general servers to their clients in the second quarter, being their first quarter of doing so. And we do expect a further ramp up in terms of the deliveries in the second half. And if you look in terms of the closest proxy to NVIDIA, we do believe that the most direct proxy is NationGate due to the AI exposure. And we do believe that in the years ahead, NationGate will continue to be a very strong proxy to actually ride on the supply chain diversification amidst the US-China geopolitical tension. Over here, like I mentioned, the recovery in terms of the foreign visitations is expected to drive recovery for Genting Malaysia. In the second quarter, we have saw your China visitation volume actually double year on year. And looking at the data point, we do expect third quarter to continue to see a sequential recovery. Hence, that will likely to drive a better sentiment for Genting Malaysia. We also have we continue to have a buy call on Critical, target price 165. So Critical is actually a mechanical, electrical, and process utility player that particularly focus on your semicon as well as your data centers. Of course, semicon in Malaysia, semicon in Penang continue to be very active. And with the up and coming data center investment, we do believe that Critical will benefit strongly from it. If you look in terms of the return of equity to shareholders, I think that they are trading at a premium compared to the rest of the peers, and that is the reason why we like the name as well. So for Critical, we do expect the contract flow in the fourth quarter or even moving to next year to be very active due to the exposure in both the semicon and data centers. Similarly, for HE Group here, HE Group is in the same business as Critical. We have a buy call target price of 90 cents. Same reason as HE. Same reason as Critical, semicon data center will continue to drive a very robust order book replenishment, and that is the reason why we do think that these two companies, Critical as well as HE, is something that is worth taking a look at. Dayang here, oil and gas name, they are a Sarawak company, so which actually gives them an edge doing business in Sarawak. They are also a market leader in what they do, and we do believe that due to the underinvestment, under maintenance during COVID, they will be benefiting very strongly from the higher activities for the sector. we have a buy call target price of 378. Usma, another one of the oil and gas name which we like, we have a buy call target price at 178. They are also a market leader in the value chain which they are servicing the clients. They are doing your wealth solutions, your plug and abandonment, focusing on production enhancement. And if we look at over the past year, Petronas has been focusing a lot on production enhancement, brownfield projects, and that is the reason why, as you can see, over the past 2 years, earnings growth have been strong, growing about, I think, double 70% year on year, and moving ahead. We do believe that both the conventional oil and gas as well as the solar segment, which they have exposure in, will drive the earnings ahead. I believe that this is my last slides here. We also like to highlight the division as something that we like. We have a buy call target price of 150. This is the only tech sector under representation. So basically, what has transpired, our buy call was they actually entered into a JV with one of the big China player called Wuxi Autowell. It's actually one of the top 10 global PV equipment manufacturer in China, of course. And we do believe that with the US-China trade war, that will actually translate to, TTVJ will actually benefit from the trade diversion into Malaysia. If I'm not mistaken, I think that my colleague is looking at about 1 billion of order book for Wuxi Autowell. So every incremental orders that is being diverted to Malaysia will benefit TTVision, being a very small tech players. As you can see, their net profit base is relatively low. So we do believe that the forward 3 years profit CAGR for TTVision is actually looking very attractive. Yeah, okay. So I think that's all for me, and we will be taking questions from here on. Okay, one of the questions is on the technology sector. I think this person is would like to know with the recent decline of the recent decline of the sector and the strengthening in terms of the ringgit. How can we? What's the outlook on the sector, and when is the time to actually turn bullish? I think yes. If you look in terms of the company, which is export orientated, including the semicon sector, I think that in the near term wise, earnings will be impacted. But if you look in terms of the fundamental wise, we do believe that the likes of your higher AI adoption, I think that all this will drive the fundamental needs for all these new and more innovative products. and ultimately that will benefit Malaysia. I think that in the past, Malaysia has been focusing more on the back end, your burn-in and packaging. But I think that moving forward, we saw that more of the tech companies is actually moving to the front end, and front end has a relatively bigger addressable market, and front end will always be the first to recover. So on that note, with the tech companies actually pivoting from the back end to front end, we do believe that we should see a quicker recovery. In terms of the ringgit strength, yes, but again, like I mentioned, I do believe that fundamentally wise, they are doing relatively okay. And of course, let's not forget the biggest team here is your China as well as Taiwan +1 strategy. So that will ultimately means that more of the orders will be diverted from the rest of the developed market to Malaysia and benefiting the tech companies. Okay, there's a question on data center, better pick between critical and HE. I think that if you look in terms of the Malaysia MEP space, your mechanical, electrical, and process utility, I think that the market is still the market is still small, in the sense that there's only a handful of players, whereas your data centers investment by a lot of the US MNCs are in the region of billions. Whereas if you look in terms of the MEP sector, the biggest company, the revenue exposure is only about 200 to about 300 million ringgit max. So we do believe that the pie is big, and it's enough for everyone to share that big pie. So we do believe that companies that is operating within this space will benefit across. So I wouldn't say that there's a better pick between both company. We think that both company will benefit equally from the semicon as well as the data centers. Okay. Okay. So there's also a question in terms of the fund flow. Of course, when we were doing the first quarter as well as second quarter marketing outlook, the small cap actually outperformed the large cap, due to the fact that your foreign equity inflow has been relatively bypassing Malaysia, and of course small cap outperformed the large cap, but only in the past couple of months, where we saw foreign equity inflow moving to the Malaysia. Hence, your large cap actually performed, and your small cap actually took a beating. But that being said, if you ask me, we continue to believe that the correction in the market is healthy, and this actually present a better entry point and more attractive point for investors to relook in the small mid cap space. But like mentioned, the small mid cap space that we like largely revolve around our seven thematic ideas. So be very selective. We are cherry picking in the small mid cap space. Sentiment, of course, has sentiments among investors has been a bit jittery. But we do believe that if positioned into the right space, small mid cap will continue to be a more attractive space to be in compared to the large cap. Okay, someone is asking in terms of thematic 1 and 2. Just give me a minute. Okay, thematic 1, maybe these participants can take a picture. Basically, it's revolving around the influx of FDIs. And thematic number 2 is basically relating to construction. Okay, a question in terms of the property sector. So the reason why we are not positive on the property sector, I think that one of the reasons is, of course, the fundamental oversupply. We think that the oversupply situation still need a bit more time for the market to absorb. But that being said, in the property sector, we do have some buy calls. We are a bit more selective. In the property sector wise, we actually like this name, AME Elite. They are a industrial park developer focusing in Johor, and they will likely benefit from the China as well as Taiwan plus one strategy. Essentially, what is happening is that your global MNCs are actually setting up, are actually diversifying their supply chain and setting up factories in Malaysia. So how companies like AME Elite will benefit is that they are helping all these US MNC to build up and set up their offices, their factories, and selling it to them. So AME Elite is one of the names that we like for the property sector. Okay, yeah, I believe that is all. Marina, over to you. Thanks.
Thank you. Thanks again, JY, for the presentation and interactive Q&A. We have now come to the end of the webinar today, and we would like to thank all of you for joining. For tomorrow, Tuesday, we will be having China and Hong Kong markets to share. Louis Wong, Director of Phillip Securities Hong Kong, will present on the Hong Kong and China outlook on Q4 and his stock picks. Remember to mark your calendars. It's on the 8th of October, Tuesday, from 12 p.m. to 2 p.m. For the session just now, we will be uploading the recording on PhillipCapital YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill out the survey so we can improve your experience with us in the future. You may scan the QR code shown on the screen later. You may also join our investing community to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us, and we hope to see you tomorrow. Stay tuned, take care, and have a nice day.